Hello, everyone, and welcome back for another Fratarcangeli Friday market update. Here we are, January 23rd, almost fully through the first month of the year. A lot of good things to talk about. First off is earnings. We're coming off of approximately 7% of the S&P 500 having reported earnings so far for the fourth quarter. And we're going to have a number of good earnings reports that we're looking forward to next week. But so far, we've had 80% of those companies that have reported earnings beat expectations, both top and bottom line. So we're off to the similar type earnings news that we've been seeing now for several quarters. And we're expecting next week's Meta, Microsoft, Tesla, as well as Texas Instruments, amongst many other industries as well as companies that we're going to be watching very closely to see how we turn the corner relative to the remaining S&P 500 and other indexes earning reports. And so far, it's been a very broad and very strong earnings growth that we've seen now basically for 4 consecutive years. And even more compelling is the fact that companies are actually guiding higher prior to earnings season and actually coming in and beating those numbers. And that's something that we have not seen consistently over the course of the last several, not only years, but decades. So a lot of good things coming on this robust earnings growth that we've been enduring now for, this will be the 3rd consecutive year of double-digit earnings growth. So we'll see how this continues. Additionally, we have economic data that's come down the pipe post the government shutdown that brought some of these numbers a little bit later than expected. For example, Q3 GDP growth came in at 4.4% year-over-year growth. Those are extremely strong patterns as well. And we're calling upon potentially 2026 coming in at GDP, gross domestic productivity, somewhere in that 5% range. This would be very strong, especially considering the fact that inflation seems to be tamed. We're calling on roughly 1 to 2% inflation for the coming year. And we're also closing out 2025 with very contained inflation. So if you have a combination of GDP expansion as well as contained inflation, these are very strong indications to a strong domestic and hopefully global economy. So these are things that lend themselves to some momentum and some positivity that we expect the markets to ultimately interpret as well as create some more upside. So watching very closely for that. We also have the Federal Reserve meeting coming up next week with a very low probability that rates will change. I think we're looking at less than 10% chance that rates actually go down any further than what they have already over the last year, which we've had 3 declines in the, call it Fed rate, the short-term rate. And we're expecting more this year, but we don't expect it to occur in this first meeting of the year in January. Additionally, we've all seen, if we've been watching any TV, some of the geopolitical issues out there. Earlier this week, we had some concerns with tariffs being extended and increased in Europe based on this discussion or debate on what's going to happen with Greenland. We seem to have some consensus and some discussions that have tamed that concern, and the markets have responded nicely after a sell-off that we endured on Tuesday. It appears as though there's been some agreement between the EU and as well Trump taking a step back on tariffs, as well as some type of a in theory agreement with Greenland and how that is going to play out. So some of the geopolitical areas that we've been watching have really come down as the week has unfolded. So a lot of positive there as well. And, you know, typically the first 3 weeks of January, that period of time, so goes the market for the year. So based on that information, we have some modest market increases, especially this week, to the tune of 1 to 2%. So certainly better than being on the opposite side of that. And so we expect that probability of outcome for the year to also lend itself to I say a fairly decent year. Let's not forget, we're in the midst of multiple factors, including the earnings growth that we're talking about. We have an election year upon us. We had a conversation with the political analyst Jeff Bush that many of you may have caught, that talked about the probability of what could happen in November and what those impacts would ultimately have on confidence as well as overall anticipated results. And the odds, as we interpreted, were that we currently have the House, the Senate, and the presidency controlled by the Republicans, albeit by a slim margin. The odds are that the House will flip back to the Democrats, and that will be at about a 65% probability as it sits. The Senate, the way things are lined up, will probably stay Republican, which means we have a divided House and Senate. and a presidency that will maintain, of course, Republican, which means that there won't be some of the concerns that we've been hearing about impeachments going through and creating more volatility because of those factors. So that's something that we're watching very closely, because historically, we've seen volatility in these types of years when we're dealing with midterm elections or elections in general. But I think the ultimate outcome will be focused, and ultimately the main categories or areas that we'll be really leaning on as it relates to outlook for the market and the economy will be the data. And so far, the data, whether it's earnings, whether it's inflation, whether it's gross domestic productivity, which we're going to be watching the data very closely, all aligns towards very positive things out there for the overall economy. We're also seeing a number of good data on income increasing, as well as consumer spending staying steady. So we'll be watching closely. I think the call to action and the takeaway is stay the course, make sure that you have enough liquidity to make it through the unforeseen and foreseen, but also make sure that your money is positioned longer term for the dollars we know we will not need for at least 5 years to combat inflation. I think those are the two critical aspects that we always, in any economic environment, want to maintain an understanding of and try to take the emotion out. That being said, I appreciate you all joining us today. I look forward to seeing you again in the next couple of weeks in a multitude of factors, including our Friday market updates. We'll be back in 2 weeks to give you an update as well. And as the country is enduring this very harsh winter, stay warm, stay safe, and I look forward to seeing you all soon. Bye for now.